What if the companies you already follow, the ones behind AI, cloud computing, the apps on your phone, didn't just rise in value over time, but actually wired cash into your account every single month? Not once a year, not when you sell, every month. It's happening right now, and a handful of funds are built specifically to do it. The question is, how much are you giving up to get it? And which one actually fits the way you want to live? Today, we're breaking down the 6 names that keep showing up when investors go hunting for monthly paychecks, including 3 you've probably never heard of that are quietly pulling in double-digit payouts. Before we get into the list, I want to make something clear: this isn't just a yield ranking. If you chase the biggest percentage and stop there, you'll almost certainly walk into a trap. A 15% payout doesn't mean a 15% return. In fact, some of these funds have handed investors enormous checks while their account balances slowly withered. So we're going to do it differently. We'll look at what these things actually own, how they manufacture the cash, and where the trade-off lives. Then I'll show you exactly what a $100,000 investment would have produced in cash flow from each one. And just as important, why that number alone isn't the whole picture. If you find this breakdown useful, tap that like button. It helps more people see the video and keeps independent analysis like this alive. Let's start with the one that's been setting off alerts. Ticker QQQI, from a firm called Enios Investments. This fund owns the NASDAQ 100, the index stuffed with Nvidia, Microsoft, Apple, Amazon, Alphabet, Meta. In other words, the companies that have been driving the world's most important technology shifts. But QQQI doesn't just collect whatever tiny dividend those stocks happen to pay. It sells call options against its positions. That's the engine. Every month, the fund pockets premiums from those options, and those premiums get passed to you. The result? A yield that's hovered between 12 and 15% recently. On 100 grand, that could mean $14,000 a year hitting your account in monthly installments. If you're sitting there thinking, wait, why wouldn't everyone just do this? You've already identified the central tension of this entire category. When you sell a call option, you give someone else the right to buy your shares at a set price. In a flat or choppy market, those options expire worthless. You keep the premium and the income flows. In a falling market, the premium softens the blow a little. But in a furious bull market, like the year AI hype sent the NASDAQ 100 ripping higher, those call options limit how much of the upside you actually capture. You'll still get your monthly check, but you'll watch the underlying index climb far faster than your fund's share price. That's the trade. QQQI gives you aggressive income stapled to tech exposure, but it caps your ceiling. For someone who wants that cash flow now and believes tech will grind sideways or rise slowly, it can make a lot of sense. If you're betting on another explosive 40% year, you'll hate it. Now, if QQQI is the tech-heavy option, its sibling SPYI broadens the lens. Same provider, similar mechanics, but instead of the NASDAQ 100, it tracks the S&P 500. You're getting exposure across healthcare, financials, industrials, consumer goods, the entire mosaic of the US economy. And it's using options on the S&P 500 index itself to generate extra income. The yield sits around 11 to 12%. On that same $100,000, you'd be looking at roughly $12,000 a year in distributions. The income is slightly lower than QQQI, but the diversification is meaningfully higher. That matters more than most people realize, because a fund that concentrates entirely in tech can see its share price get chopped in half if the sector rotates out of favor. And when the share price falls, the dollar amount of your distributions can fall with it, even if the yield percentage looks stable. SPYI trades some peak payout for a smoother ride, which is exactly why it often tops the best balance lists. You're not betting the ranch on any single narrative. You're collecting premiums on the entire American equity market. Next up is JP Morgan's entry, JEPQ. This one also lives in the NASDAQ neighborhood, with a heavy tilt toward growth and AI names, but JP Morgan runs a slightly different playbook. They combine active stock selection with an options overlay that's designed to deliver high monthly income without completely severing the link to equity growth. Distributions have been landing around 9 to 11%. That's lower than QQQI's on the surface, but potentially more sustainable because the fund explicitly tries to capture a portion of the market's upside. The real headline here is the manager. JP Morgan's massive institutional resources go into the portfolio construction. And for a lot of people, that brand provides a sense of reassurance that a small, newer ETF shop might not. Just know that you're still heavily concentrated in technology, which means volatility doesn't vanish, it just gets repackaged as income. Its cousin JEPI takes the opposite approach. Here, the stock selection leans away from high-flying tech and into lower volatility, defensive names, companies that already exhibit stability. Then it layers options income on top. The result is a lower headline yield, something in the 7 to 9% zone, or about $8,000 a year on 100 grand. But the drawdowns tend to be shallower, and the distribution stream has been more stable. This is the one that gets shouted out constantly in retirement communities and early retirement forums. Not because it makes the most money, but because it's engineered to lose less while still paying you. If you think about your portfolio as a machine that needs to keep running for decades, JEPI prioritizes the machine's survival over its sprint speed. After those 4, we hit QYLD from Global X, which is essentially the blueprint the others built upon. It's the oldest and simplest covered call NASDAQ ETF. Own the index, sell at the money calls every month, distribute the cash. The yield often prints between 11 and 13%. That's historically been the bait, and it works. The fund has amassed billions doing exactly this. But here's the catch that not enough people talk about. The total return, meaning share price appreciation plus dividends, has consistently lagged the underlying NASDAQ 100 by a wide margin because the upside gets clipped so aggressively. Look at the chart over any long stretch. The distribution line is beautiful, the share price line is not. QYLD has essentially converted growth into income. For someone who needs maximum cash flow right now and doesn't care about leaving a larger asset base to heirs, that might be acceptable. For a 40-year-old trying to build wealth, it's a very expensive payday. Finally, we need a counterweight. SCHD, the Schwab US. Dividend Equity ETF doesn't sell options. It doesn't use derivatives. It just owns companies with strong balance sheets and long histories of paying and growing dividends. Think Coca-Cola, Home Depot, PepsiCo. The immediate yield is lower, around 3 to 4%, which is $4,000 a year on 100 grand. And technically, SCHD pays quarterly, not monthly. So why include it? Because this video would be incomplete without acknowledging the fork in the road. The options income ETFs we just covered are pulling income forward, often at the expense of long-term compounding. SCHD does the opposite. The income grows over time. The companies inside it tend to raise their dividends year after year. So the yield you capture today on your cost basis can compound into a much larger effective yield a decade from now, without sacrificing share price appreciation. The trade looks lousy if you only measure month one's cash flow. It doesn't look so lousy when you measure the total pile of assets you end up with. Let's put this all on one screen. Imagine you started with $100,000. QQQI might have thrown off around $14,000 in year one. QYLD and SPY around $12,000. GPQ roughly $10,000. JEPI $8,000. SCHD $4,000. 14 grand feels a whole lot better than 4 grand when you're staring at a brokerage statement. But here's the second order effect nobody downloads an app to hear about. That cash flow isn't created from nothing. In the high yielders, a chunk of that distribution is effectively your own capital being handed back to you, especially if the share price is declining while the yield percentage stays high. A 15% yield on a shrinking asset base eventually buys you less lifestyle than a 4% yield on a growing one. The number on the cash flow statement isn't the same as the number on your net worth statement. So how do you choose? It depends entirely on what problem you're solving. If you need maximum income right now and you accept that your principal might not grow, QQQI and QYLD sit at the top of the income stack. But if you want a balanced, solid monthly cash that doesn't completely obliterate your long-term growth potential, SPYI and JEPU tend to land in the sweet spot. SPYI offers the broader market diversification. JEPQ offers the institutional tech tilt. For stability, the kind of distribution stream you'd build a retirement withdrawal plan around, JEPI has been the workhorse, and SCHD is the quiet compounder humming in the background. And by the way, you're not forced to pick just one. A lot of people blend these, using something like GP to cover baseline expenses and letting SCHD build the future, or combining QQQI with SPYI to capture tech without putting everything on that one horse. The most dangerous sentence in investing is, just give me the highest yield. These ETFs live at the intersection of psychology and the math always wins. A monthly paycheck feels like a paycheck. It's addictive. The funds know that, and the yield is the marketing. Your job is to understand what's happening underneath so you don't wake up 5 years from now with a stack of deposit confirmations and a share price that's been quietly eroding the whole time. Income is not a magic trick. It's a conversion. The question is exactly what you're converting, and whether that trade-off actually matches how you want to live and invest. If you're running one of these in your portfolio already, or you've got a different monthly payer you swear by, drop the ticker in the comments. The conversation down there is usually more interesting than the video itself. And if you want a deeper dive on any single fund, the option strategy mechanics, the tax treatment, how to spot a distribution that's shrinking in real terms, let me know. That's all for today. Thanks for watching.